Hello, and thank you for joining me for our second quarter economic update. I'm Angela Palacios, Director of Investments here at the Center. Let's dive right in. I'd like to start with a look at the consumer, as we drive about 70% of all economic activity in the U.S. On the left is the personal savings rate, or how much we are saving on average as households. We had a spike during the pandemic, and since reopening the economy, you can see revenge spending taking over. Savings rates are back down near the lowest we've seen in the past 60 years. The top right chart shows in the blue shaded area how consumers have been drawing their accumulated savings back down. As savings fall, credit outstanding has increased back near pre-pandemic levels, as you can see in the bottom right-hand chart. In my opinion, these charts show the consumer doesn't have a lot of excess savings left to spend, which should help inflation continue to normalize. The next chart demonstrates unemployment, the dark gray line, and wage growth, the light blue line. While unemployment remains low, wage growth continues to come down, which is also very impactful to inflation. As consumers get fewer raises, they have less money to spend. This is consistent with those first charts in showing that inflation should keep coming down. We would need to see this number continue to decrease back to long-term averages to help inflation. Oil prices are also a volatile factor in inflation. You may have heard that OPEC has decided to extend their production cuts past the end of this year and are considering further cuts. On the surface, this sounds inflationary, but I think it's important to review the state of the overall production and consumption market to understand if that is actually the case. As you can see in this chart, the first section is production by the major oil producers, and the first line of that section is U.S. production. In the past 5 years, the U.S. has produced significantly more oil per day, more than the cuts from OPEC. While the bottom section shows that the U.S. consumption of oil has leveled off in the last 4 years. China has picked up, but globally, oil consumption has remained flat. Nothing here points to increasing oil prices in the near term. Watching the leading indicators of inflation is important not only to understand how inflation is going to continue to hit our wallets or not, but also to determine the potential next steps of the Federal Reserve. The Fed actions could also determine if the economy falls into a recession later this year or early next year. Remember, by raising interest rates, the Fed is actively trying to put the brakes on the economy. They are succeeding in the data we have seen so far, but since there is a lag in their decisions flowing through to the economy, many worry the Fed will go too far and send us into a hard landing rather than a soft landing, or a more severe recession rather than a mild recession. The leading economic indicators are trending negative, which usually occurs before a recession. In this chart, you can see the blue line declining in advance of the gray shaded areas, which are recession time periods. So a recession is looking likely, but the question remains as to whether or not it will be short-lived and shallow. We have taken action to cushion portfolios in the event this does occur. We are actively making sure you have the cash you need, especially since you can earn a good interest rate on that now. We have also trimmed equities in favor of interest-bearing securities to help cushion during a market pullback. We also remain shorter duration on bond portfolios until it becomes clearer the path of the Federal Reserve. If you have any questions, please don't hesitate to reach out to us for a more in-depth update. Thank you for listening.